October 1907. Wall Street is burning. Not literally, but financially, it might as well be. People are lined up around the block, desperate to withdraw their life savings. Banks are collapsing one after another like dominoes. The entire American economy is hours away from total annihilation. And the man who could save it, he's not a politician. He's not even in government. He's a banker. One banker. And what he does next will change money forever. This is the story of the panic of 1907, the financial crisis so devastating that it forced America to completely redesign its monetary system. And here's the crazy part. We're seeing the exact same warning signs today. Let's set the scene. It's 1907, and America is an economic powerhouse. The Industrial Revolution is in full swing. We've got railroads crisscrossing the country, steel mills pumping out metal, and money flowing like never before. But there's a problem. Actually, a massive problem. America doesn't have a central bank. Think about that for a second. The world's rising superpower has no Federal Reserve, no lender of last resort, no safety net. If your bank fails, your money is just gone. If banks run out of cash, they can't borrow from anyone. The entire financial system is basically held together with duct tape and prayer. And it gets worse. At this time, American banks operated on something called the correspondent banking system. Basically, small local banks in places like Kansas or Tennessee would deposit their money with bigger banks in New York. Those New York banks would then lend that money out to make even more money. Sounds reasonable. Right? Wrong. Because those New York banks were lending out way more money than they actually had in deposits. We're talking about reserve ratios as low as 10% or even 5%. They were leveraged to the absolute max. This created a ticking time bomb. All it would take is one spark, one loss of confidence, and the entire pyramid scheme collapses. And in October 1907, that spark appeared. His name was Augustus Heinze. And he thought he was a genius. Heinze was a copper mining magnate who had made a fortune in Montana, but he wanted more. So he came to New York with a scheme. He was going to corner the copper market, buy up all the copper, control the supply, and watch the price skyrocket. To do this, he needed money. Lots of it. So he used his connections to take control of several banks and trust companies, then used their deposits to fund his copper speculation. On October 14, 1907, Heinze made his move. He started buying massive amounts of United Copper Company stock, trying to squeeze out short sellers and drive the price through the roof. For a few days, it looked like it might work. The stock started climbing. Heinze and his brother were on top of the world. And then, it all fell apart. The short sellers fought back. They found shares Heinze didn't know existed. The stock price collapsed. In 3 days, United Copper went from $60 to $10. Heinze was wiped out, and suddenly, everyone realized something terrifying. If Heinze's banks had been funding this speculation, they were probably broke. On October 21st, the bank runs began. First, it was just Heinze's banks. Lines formed outside the Mercantile National Bank. Depositors demanding their money. The bank couldn't pay everyone. It collapsed within hours. But here's where panic becomes contagion. People started wondering, if that bank failed, what about my bank? Is my money safe? Within days, the panic spread to trust companies, financial institutions that were even less regulated than banks. The Knickerbocker Trust Company, one of New York's largest, faced massive withdrawals. On October 22nd, Knickerbocker tried to open for business. They had a line of depositors stretching around the block. By noon, they had paid out $8 million. By 2 p.m., they were out of cash. They locked the doors. The third largest trust in New York had collapsed. And that's when the real panic started. By late October, New York's financial system was in free fall. Banks were hoarding cash, refusing to lend to each other. The stock market was plummeting. Major corporations couldn't get loans to meet payroll. The entire American economy was grinding to a halt. And remember, there's no Federal Reserve, no government bailout, no FDIC insurance, nothing. So who could possibly stop this? Enter J.P. Morgan. At 70 years old, John Pierpont Morgan was the most powerful banker in America, possibly the world. He had financed railroads, steel companies, and entire industries. When J.P. Morgan spoke, Wall Street listened, and on October 23rd, Morgan decided to act. He called a meeting at his private library in Manhattan. Every major banker in New York was summoned, and Morgan delivered an ultimatum. Either we work together to save the system, or we all go down together. For the next 3 weeks, Morgan basically became America's central bank. He organized bank rescues, strong-armed healthy banks into lending to struggling ones, and even got the clergy to preach sermons urging people not to panic, but the crisis kept escalating. The New York Stock Exchange was on the verge of collapse. They literally didn't have enough money to close out the day's trades. If the exchange closed, it would trigger absolute chaos. Morgan gathered the bank presidents again. He locked them in his library, literally locked the doors and told them nobody was leaving until they agreed to pool $25 million to save the exchange. They argued. They resisted. But Morgan was immovable. Finally, at 4:45 a.m., they signed. The stock exchange was saved. But Morgan wasn't done. The next crisis was the Trust Company of America, which was hemorrhaging deposits. If it failed, it would take down half of Wall Street with it. Morgan gathered his team and did the math. How much money did they need? Could they raise it? After hours of calculations and negotiations, Morgan stood up and declared, "This is the place to stop the trouble." He personally guaranteed the trust company's solvency. Other banks, seeing Morgan's commitment, joined in. The tide began to turn. By mid-November, the crisis was over. J.P. Morgan had single-handedly prevented the collapse of the American financial system. He was hailed as a hero. Congress even gave him a medal. But here's what everyone realized: we just got lucky. Think about that. The entire U.S. economy's survival depended on one 70-year-old man being willing and able to intervene. What if Morgan had been sick? What if he'd been traveling? What if he simply didn't care? The panic of 1907 exposed the fundamental insanity of America's banking system. We were the richest nation on earth, but our financial infrastructure was a joke. Senator Nelson Aldrich led a commission to study the crisis and recommend solutions. They traveled to Europe, studied the Bank of England, analyzed other central banks, and they came back with a radical proposal. America needed a central bank. Of course, this was controversial. Americans had a deep distrust of centralized banking. We killed to previous attempts at central banks in our history. People feared it would give too much power to Wall Street bankers or to Washington politicians. But the trauma of 1907 was too fresh. The debate raged for years. But finally, on December 23, 1913, President Woodrow Wilson signed the Federal Reserve Act into law. The Federal Reserve, the Fed, would be America's lender of last resort. It could inject liquidity into the banking system during crises. It could set interest rates to manage the economy. It would, in theory, prevent another 1907 from ever happening. And here's where the story gets really interesting. Did it work? Well, kind of. The Fed prevented some crises, but it also arguably caused or worsened others. Some historians say the Fed's mistakes helped trigger the Great Depression in the 1930s. Others argue that without the Fed, the 2008 financial crisis would have been far worse. The truth is, the Federal Reserve transformed how money works in America. It gave the government enormous power over the economy. It enabled deficit spending on a scale that would have been impossible before. It made modern finance possible for better and worse. So why am I telling you about a crisis from 117 years ago? Because the same patterns are playing out right now. Think about 2023. Silicon Valley Bank collapsed, the second largest bank failure in American history. Why? Because they made risky bets, interest rates changed, and suddenly they didn't have enough liquid cash to meet withdrawals. Sound familiar? The difference is, this time we had the Fed. They stepped in with emergency lending programs. They prevented contagion. They did exactly what they were created to do after 1907. But here's the question that should keep you up at night. What happens when the Fed can't fix it? Look at what's happening right now. Global debt is at record highs, over $300 trillion. We've got rising interest rates, geopolitical tensions, and a banking system that's more interconnected and complex than ever. The issues we're facing today echo 1907 in disturbing ways. Over-leveraged institutions taking massive risks, interconnected financial systems where one failure can cascade public confidence in banks being tested, questions about who holds the real power over money. The Fed was created because one crisis proved we needed a systemic solution. But what happens when the Fed itself becomes part of the problem? Some argue we're witnessing the slow-motion collapse of the dollar-based financial system that emerged from that 1907 crisis. Others say modern central banking has made us more resilient than ever. History doesn't repeat, but it rhymes. The panic of 1907 taught us that financial systems built on confidence are fragile. One moment of doubt, one cascading failure, can bring down the entire structure. The Federal Reserve was the solution to the last crisis. What will be the solution to the next one? The panic of 1907 changed everything. It proved that free market banking without oversight was a disaster waiting to happen. It created the Federal Reserve, which has shaped American and global finance ever since. But most importantly, it taught us this lesson: financial crises aren't random, they follow patterns: excessive leverage, loss of confidence, contagion, panic. We saw those patterns in 1907, we saw them in 1929, in 2008, in 2023, and we'll see them again. The question isn't if another crisis will happen, it's WHEN. And whether the institutions we've rebuilt, the ones born from the ashes of 1907, will be enough to save us, or whether we'll need another JP Morgan to lock bankers in a room until they fix the problem. Thanks for watching. If you want to understand the financial system we live in today, you have to understand where it came from. The story of 1907 isn't just history, it's a warning. Hit subscribe if you want more financial history that actually matters, and drop a comment. Do you think the Fed has been good or bad for America? I'll see you in the next one.